Hello again, welcome to South Tonight, coming to you from Blackwater Castle in Castletownroche in North Cork. And as castles go, this is one of the best kept secrets around, and I'll be finding out a little bit more about this wonderful place later on when I'm joined by the proprietor Patrick Nordstrom. Now though, first up, on a financial note, we're going to be discussing right now what protection policies are available to take out when getting a mortgage, and Jerry Owens is here to advise us on that. Hello Jerry.
Martina, how are you?
Very good, thank you. Now, in terms of protection policies, there are some that are necessary and there are others that are optional. Can you explain the difference to me first?
Okay, no problem. When someone buys a mortgage under current legislation, you must put in place a life protection policy, such that in the event that you die, the loan is paid off. In addition, you must also put a protection policy in place to cover repairs to the property in case it's damaged. We have had people who've gone out for a Saturday afternoon to come home and find the house completely burnt out. So you need to have a policy in place that will rebuild that policy, as we say in the industry, to reinstate the property back to where it was before the damage occurred.
So that's known as home insurance,
That's
really?
home insurance, exactly.
Okay, and then the other one is life assurance.
Life assurance. But in life assurance, there are different policies one can take, either to include or not to include serious illness cover. And what serious illness does is, if somebody is diagnosed with a specific illness that's listed by the life company, then the loan balance can be completely repaid. Or they could take a level of protection. It may not necessarily cover the full mortgage. They might take a limited amount of serious illness cover, but not to cover the full mortgage. Just in the event that if an illness happened, they would have a chunk of money that they can use to maybe either pay off part of the mortgage or to seek medical assistance.
All right, and what kind of feedback do you get in your line of business in relation to that? Do people say, no, I'll be grand, or are they being more cautious? People
are being more cautious, and certainly the industry is becoming certainly more instructive in explaining to people exactly what is involved in these policies. And you can have a level term cover where the cover remains for the full term of the mortgage, or you can have reducing balance. Now, the reducing balance is the cheapest, but it isn't necessarily the best policy. And again, it is a matter for each individual to discuss this with their provider to make sure they're buying the policy that suits them and their needs.
And would you find that maybe people who are age 20 or in their 20s are less likely to go down that route than maybe older people who consider illnesses as being more of a serious option?
It depends. And in some respects, what can influence some people is that they'd hear of somebody they know who has suffered an illness or who has died unexpectedly. And then it brings it home that, look, this is a 35-year term maybe for the mortgage. So I need to put the protection in place now. No, you can't close the door when the horse is bolted.
Are there other kind of policies then as well besides that?
There are, and certainly in the current climate, one policy that's become particularly of issue is payment protection policies. Now that's different to income protection policies. It's a payment protection policy. And what it does is, people sometimes will be out of work for a very short period of time. It might be only 6 months. And in that 6 months, this policy will pay the mortgage payment for those 6 months. Now generally they're for 12 months, they could be for 2 years, they could even have a limited serious illness cover in that as well. But generally speaking, it's a policy that would last for 12 months per event. Now you could have somebody who was out sick, could claim for 6 months on that until they recover. And then 6 months later, they could be in a redundancy situation and they'd claim under that. That's a separate event. Now, the one thing that they must be very careful about, though, is it doesn't cover pre-existing events. So if you had a bad back and you had a previous injury and then you claimed under the policy, well, that won't work because that event was pre-existing buying the policy.
I see. So if someone was long-term unemployed, like if they had a policy that was to last for 12 months and they found themselves unemployed for 3 years, let's say, what would happen in that case?
Well, they only have cover for 12 months, unless they bought a 2-year policy. But you would set the term yourself when you buy the policy.
Can you go back and buy another policy then?
No, the policy carries on. Once you've recovered, if somebody was unemployed, as you say, even for 1 year or 2 years, and then became employed, once they're employed for more than 30 days in a permanent employment, then the clock has gone back to zero. If that employment was to end, then they have 12 months under that employment.
Right. Okay. Now, is there anything else borrowers need to be aware of?
Well, I'd like to come back to the life assurance, because that seems very simple. Some people are, at times, they might feel, well, look, I'm a smoker, or I have a condition. So if I don't tell them, they'll never know.
That would be a mistake.
That would be a huge mistake, because that's a material issue that would affect the underwriter, the person who writes the risk for the life company. They need to know that so that they can properly gauge the risks the life company is taking in taking you on as a customer. Now, smoking is a biggie because people will often think, "Gosh, I only have a cigarette at Christmas. I only have a cigar at a dinner." That doesn't count. Everything counts. Once you answer the question, have you smoked tobacco in the last 12 months? If you say no, and you do, and the thing is, it doesn't matter how you die. If you're hit by a car, tests will be done as to what happened to you because it was unexpected. And they can do blood tests, and the blood tests will be able to say whether somebody was a direct smoker, i.e. smoking cigarettes, or a passive smoker. And if it's found that you were a smoker, and people think, well, why would the insurance company, should they know I was hit by a car? The difficulty is that the insurance company have to do an investigation as to why you died. Mm-hmm. So as part of their prudence, they must just check it out, by the way, and they will ask the doctor, for example, was your client a smoker? So that's one source of information. But even if the doctor didn't know, and they have tests done just to see they may do toxicology tests as part of the crash, because was the person under the influence? Were they under drugs? Who knows?
Sure.
So therefore, tests are being done, and the information is available. So medical reports will be sought.
And if you've lied, it's null and void then.
If the insurance company find out that, look, this person was a smoker, then the policy is then void.
All right. And is age a factor in terms of the price of taking out these payments? If you are older, will they be more expensive?
Obviously, yes. Yeah. I mean, a younger person would have longer life expectancy, and therefore their policy is cheaper. And that's why we say to younger people, when you're young and you have full health, it's a great time to buy life assurance because it is going to be cheaper. Whereas when you're older, it does cost more because the life company is saying, well, life expectancy is maybe to 84 years of age. If you take it out at 50 years of age, technically they say you have 34 years to live. Okay, so as you get older, life assurance becomes more expensive.
All right, and just finally, what happens if you're in arrears with your payments anyway and you need your protection policy then to kick in?
Now, in terms of life assurance, I'm glad you asked that question. The life company is covering the balance of the mortgage, if it's a reducing balance mortgage policy, based on you paying your mortgage. But if you haven't paid the mortgage, it'll only cover what the balance should be had you paid your payments. So if you were 2,000 or 3,000 in arrears, that will be paid for by some other source after making the claim on the policy. In relation to the payment protection plan, the beauty of having that plan is that you don't go into arrears, because the company will come in, once you're out of work for 30 days, you make your claim, and they'll start paying you 30 days in arrears. So they keep paying back the mortgage to you for those 30 days, and then the next 30 days up to a 12-month period. And hopefully in the 12 months, you've been able to regain your employment, because you may be out due accident, it could be an illness. If it's redundancy, you're trying to get another job.
All right, and I know I was going to talk to you a little bit more about the property insurance as well, but I think we're going to have to leave that for the next day. But you will be back with us again next Monday. That's Jerry Owens from Mobile Mortgages. And if you have any questions indeed for Jerry, send us an email to info@channelsouth.ie. And thanks very much for being with us once again on the show. Now, we're here in Castletownroach in North Cork all this week for South Tonight. And in the most gorgeous castle you can imagine. It really is lovely. It's called Blackwater Castle. And I'm going to be meeting the proprietor, who's called Patrick Nordstrom, and that is coming up in part 2 of the show.